Hey, good afternoon, everybody. Uneducated Economist here. Huge day in the Dow yesterday. Anybody catch that? 602 points on the 12th of November. This article came out yesterday from CNBC. The reasons to be bearish on the stock market now are swamping the bull case. The article is pretty much a bearish scenario on just about every aspect of it. So, of course, I loved it. But, they have some quotes here from some of these economists, and I just love the way these guys speak, right? They speak in a way that it seems like it's code, that they're the only ones who really understand it. But this is what it has to say, and I highlighted it here to give you the quote. It says, ongoing risks keep us cautious, and we continue to recommend that investors par back risk if their equity holdings are above long-term strategic allocations. So what they're saying there is that unless you plan on holding for the long time, get out, right? That's what they're saying. And then he goes on to say, this is the senior strategist from Charles Schwab, right? He goes on to say, economic and earnings growth rates may be peaking while the labor market continues to tighten. This mix contributes to higher wage growth, possibly higher inflation, and related uncertainty with regard to the Fed policy. Again, I just love the lingo that these guys use. So economic and earnings growth rates may be peaking. So what this Charles Schwab, senior strategist, is using the word peaking, right? We have reached the top and now starting to head down the other side. And he is saying that, when you have this peak in the economic growth, you have a lot of jobs out there. And with all these jobs available, now the employers are now in competition to get the best employees, so they have to, raise what they pay. And if everybody around is starting to earn more money, now you got a fear of inflation kicking in, right? Because all this money that they have basically printed up, loaned into the system, is now entering the people's hands. Okay, that's why they're worried about inflation. And then related to uncertainty regarding the Fed. Now, of course, everybody is just eager to hear what the Fed has to say. Are they raising or are they not raising? Are they going to drop the interest rates? What are the Fed going to do? The Fed has so much power over this economy now that they'd have to just merely whisper a hint of what they're going to do in the future, and it causes the markets to go into huge turmoil. So that's what he's meaning by uncertainty in the with regard to the Fed policy. Goes on, another economist economist here. What was it? I guess it was a paper that was authored by 3 different people. This Liz Saunders, Brad Sorensen, and Jeffrey Kleintop. But anyway, what it goes on to say here, the quote says, but given the uncertainties that still exist and the potential slowdown in both earnings and economic growth, we continue to recommend a fairly cautious approach to investing, including discipline around diversification and rebalancing. Okay? So let's break this down into normal terms again. Including discipline around diversification and rebalancing. Okay? What they're saying with that, with the rebalancing, is get out of your stocks now. If your stocks are high, are up in you're really happy with the value of your stocks, sell out now and rediversify into other aspects of the market that may do better in, say, a downturn. Right? They didn't exactly say that, but they say discipline around diversification and rebalancing. Right? So if you have all these stocks that have just boomed over the last 10 years and you're just really kicking ass in your portfolio and stuff, they're saying that you might want to consider taking your profits and diversifying it into something else. That's what they're saying right there. And then one of the other things it has mentioned here, it goes on to say, it says, unlike in 2016, there are no more tax cuts to salivate over, and the deregulation momentum is going to now slow, or maybe stall in the House. Okay, so that's pretty interesting in itself, right? They're saying there's no more tax cuts coming, right? So, all the tax cuts that supposedly boosted the economy, that part's over. That's what this guy is saying, right? And then he goes on to say the deregulation momentum may be slowing. So as they were deregulating all these markets, it's making it easier and easier for the money to flow. They're saying that that's probably going to come to an end, right? So yeah, another reason to be worried about a possible recession in the future if those regulations, either kick back in or the deregulation stop. So this one, David Rosenberg, chief economist and strategist at the Gluskin Sheaf. I'm Not real familiar with these guys. But anyway, he goes on to say, rare is the day when the stock market goes down in the lead up to Thanksgiving. And if it does, that indeed will be a very bearish signal, right? Well, we had a 600-point drop yesterday in the Dow. And today, before I started the video, we were down 80 points. So, yeah, this guy is saying that if that continues, you better hold your hats, man, because this is going to be a bearish signal for the thing, for the economy. Okay. The Schwab strategist goes on to say this. A pause in the tightening campaign might be cheered by markets, but only if economic growth remains healthy and inflation risk has ebbed, right? So what he's going on to say there is that, yeah, when they did the tightening policy where they started raising the interest rates, caused a ripple through the market to start slowing down, right? And what he is saying here, a pause in that tightening, right? So if they don't continue to raise the interest rates, if they don't do that, the market should be happy about that, okay? But that's only if the inflation risk remains low, right? So as long as they don't see this bout of inflation coming, then keeping the interest rates low will be okay. We all have our own opinion on whether or not the inflation is going to be kicking in. I'm telling you that it's going to. A lot of people either say, hey, there's no inflation out there. You can't print up all that money and expect there to be no inflation. It's going to eventually enter the market at some point, right? If the Fed is forced to lift its foot off the brake due to sharper rolling over of growth or in the face of rising inflation, markets would not likely take that as kindly, right? So if the Fed is just like, oh man, the economy is starting to go bad, we gotta ease up on the interest rates hikes and start lowering interest rates again, right? And if they have to do that while there's inflation coming, the markets are going to look very downly upon that. Okay, that's what he's saying here. If the Fed is forced to lift its foot off the brake due to sharper rolling over of the growth or in the face of rising inflation, markets would not likely take that as kindly. All right, so yeah, rising of interest rates. If the Fed is forced to stop the rising of interest rates, then the market's gonna be unhappy about that. At the point of unemployment rates at the point the unemployment rate begins to tick higher, it is likely that the countdown to the recession will begin based on history. Right? So what they're saying there is that if that unemployment that is so low right now, historically low, kicks up a little bit, it's on. It's on. So yeah, this article here is really stating a lot of cases in the bearish scenario, right, coming out of CNBC, and I really agree with a lot of this stuff. The only problem I have with this article is that on the bullish side, like the bullish part of the scenario, the only thing they could ever come up with as far as a reasonable argument towards it is that historically it should be a bull market. They're going back and they're looking at the past Novembers, right, to see how well they have done. And then they went back and looked at like past Novembers during a midterm election, right, and it's like never have gone down, So they have like all these scenarios, past history that says, well, ultimately we should be, doing pretty well in this bull market, even though we don't really have any proof of that. We're just going off of historical charts and stuff. I don't buy that for a second. But yeah, it was pretty interesting to read. I suggest you guys go check it out for yourself. The reasons to be bearish on the stock market now are swamping the bull case. Talk to you guys later.